How do you kind of create a framework to evaluate what's happening and what the impact of that will be in the future? Is there a specific framework that you use?
The closest thing I have to a framework is the concept of the long-term debt cycle, popularized by Ray Dalio. And so that's the idea that, we go through these 5 to 10 year business cycles with rising debt, and you have a recession, and then you go into the next cycle. But if you string a bunch of those together, what we've actually seen is that each cycle doesn't reset to the previous one in terms of debt or interest rates. And so what you get is higher and higher debt as a percentage of GDP over time, and you get lower, lower interest rates. And that happens for decades until interest rates run into roughly zero, or in some cases mildly negative. And so they run out of that policy room and have to pull in other types of tools. And so the last time we were in this type of environment in most developed countries was actually back in the 1940s. And so, we have a lot of analogs to that time, obviously with different technology and things like that. So that's actually my main, probably model framework. But then, more tactically, I'm just kind of looking at what are the bottlenecks in the system that would force, say, policymakers to do something. And so because we're at the end of a long-term debt cycle, we're in a very macro-heavy environment. And so some of the things that people expected over the past, say, 30, 40 years are behaving very differently in this environment. That's how I approach it.
Got it. How do you think of your portfolio today? So, like, is there an allocation that you kind of are targeting, or if somebody was said to you, like, where are you invested at the moment, just so they have that perspective of kind of how you're tactically actually playing in the market?
I have kind of like an all-weather approach, right? I remain somewhat diversified. However, I tilt towards areas that I think are, likely to have a much stronger performance over, say, a 5 year period. And so that includes for me, I'm a pretty equity focused, so I include a lot of individual equities. And then I have some other hedges or asymmetric bets on the side. And of course, ever since early 2020, I've been pretty big into Bitcoin as well. And so for me, it's, my portfolio is mostly underweight, the bond side, for example, and pretty heavy into equities, digital assets, some commodity exposures. And that's where a lot of my focus is over the past few years.
We today saw that the Nasdaq hit another all-time high, and it almost feels like it's like a weekly occurrence now that asset prices just continue to go higher and higher. Yes, there's some drawbacks here and there, but for the most part, we're just trending in one direction.
So a lot of it is the currency going down just as much as the assets going up. But we see, for example, there are certain balances in the system, and so in the United States case, we run very large trade deficits with the rest of the world. And then they take those dollars and they used to reinvest those back into treasuries. And, to a greater extent, they've been investing elsewhere, but they actually are cycling a lot of that back into US equities now. And so, basically, Switzerland, for example, will buy Apple stock in their Swiss National Bank. And so that's kind of a policy we've been seeing both from public pools of capital and private pools of capital overseas. And so this feedback loop is pretty persistent. But every couple of decades, that whole kind of feedback loop can unwind. And so, I think it's getting pretty heated at this current time. And I think some of the things to watch for potential reversal would be, say, changes in regulation that maybe go after corporate taxes, or that, basically we've seen over the past few decades is arbitrage where productivity's gone up a lot, but wages have not. And that's because of automation technology as well as offshoring. And so that gap between productivity and flat wages has mainly gone to the corporations. And so we've had, roughly, 4 decades of that. It really accelerated in the 90s. And so that loop is starting to get kind of pushback from populism and some policymakers. And so I still think that has a little bit more to go. But I do think that eventually is going to that pendulum is probably going to start moving back in the other direction, where policymakers, I guess, favor corporations a little bit less than they have over the past few decades.